You gave a company one man's word, and a $47 billion valuation followed. That is where this story begins. By the end of this video, you will understand something that the financial press largely missed when WeWork collapsed. This was not simply the story of a charismatic founder who flew too close to the sun. It was the story of a board of directors, experienced, compensated, legally obligated to protect investors, who were persuaded to hand one man almost total control of a company burning through cash at a rate that had no modern precedent. What happened next cost ordinary investors, pension funds, and employees billions of dollars. And the man most responsible for designing that system of unchecked authority walked away with a check for $1.7 billion. This is educational analysis of publicly available information, including court filings, regulatory documents, and verified reporting. It is not a legal accusation against any living person or company. WeWork was founded in 2010 by Adam Neumann and Miguel McKelvey in New York City. The premise was simple: lease large office floors, divide them, and rent smaller units to startups and freelancers at a premium. It was, structurally, a real estate arbitrage business. But Neumann did not sell it as that. He sold it as a consciousness-raising movement. He told investors WeWork's mission was to elevate the world's consciousness. He told staff they were changing the way humanity worked. And for a period that lasted nearly a decade, a staggering number of sophisticated people believed him. SoftBank's Masayoshi Son met Adam Neumann in 2017. According to reporting by the Wall Street Journal and confirmed in subsequent legal filings, Son toured a WeWork space for roughly 12 minutes before committing to invest $4.4 billion. Son would later describe Neumann as possessing the animal smell of a true entrepreneur. By 2019, SoftBank had poured a total that would eventually reach $18.5 billion into WeWork, the single largest loss in venture capital history. What Son also did, and this is the point the coverage has consistently underweighted, was help structure WeWork's governance in a way that made independent board oversight nearly impossible. Neumann held shares with 10 votes per share compared to 1 vote for ordinary shares. According to WeWork's own governance documents, Neumann could appoint his own successor. Even his wife Rebecca held a role in that succession process. Critics argued at the time that this structure did not resemble a public company preparing for a market listing. It resembled a monarchy preparing a coronation. $1.9 billion lost in a single year, on revenue of just $1.8 billion as WeWork's S-1 filing landed in August 2019. What investors and analysts read inside it ended the fairy tale in 33 days. The company had lost $1.9 billion in 2018 alone, on revenue of just $1.8 billion. It was spending more than it earned, dollar for dollar, at industrial scale. At the same moment that filing was being prepared, WeWork was signing leases on 600,000 square feet of office space every single week. Long-term lease obligations, fixed costs, in a business model that collected short-term, flexible rent from tenants who could leave at any time. The S-1 also revealed that Neumann had been paid $5.9 million by WeWork to license the word "we" back to the company he founded. He owned the trademark personally. The company he ran paid him to use it. After the detail became public in September 2019 and triggered widespread outrage, the transaction was reversed. But the fact that it had existed, that it had been approved by a board, reviewed by lawyers, and inserted into a document filed with the Securities and Exchange Commission, told observers something about the culture of oversight inside WeWork that no reimbursement could undo. Here is the reframe that changes everything you think you know about this story. The public narrative settled on Adam Neumann as the villain, a founder drunk on his own mythology. But the board knew. SoftBank knew. The bankers at JP Morgan and Goldman Sachs, who were preparing to underwrite the IPO, knew. The governance structure that gave Neumann unchecked authority was not hidden. It was written into the filing and approved by every institutional actor in the chain. What the S-1 made impossible to ignore was not new information. It was public confirmation of what informed insiders had been watching for years. The rage this story deserves is not directed at one man's ego. It is directed at an entire system of professional oversight that chose repeatedly not to function. The IPO was formally withdrawn on September 30th, 2019. Neumann was removed as CEO. In the weeks that followed, WeWork laid off approximately 2,400 employees. Some learned about their termination before receiving any formal severance communication. The man who had built the company that could not afford to continue operating left with a package that included $1.7 billion in stock buybacks, loan forgiveness, and consulting fees, a figure confirmed by SoftBank's own public disclosures. $18.65 billion in debt. When the doors finally closed, the story did not end in 2019. WeWork continued operating, restructured, went public through a SPAC in 2021 at a valuation of $9 billion, and continued bleeding cash. On November 6, 2023, WeWork filed for Chapter 11 bankruptcy, listing $18.65 billion in debt against assets of just $15.06 billion. More than 40 United States locations closed immediately. Landlords, vendors, and employees were left holding obligations the company could no longer meet. SoftBank's Vision Fund lost tens of billions across its portfolio, and WeWork represented its most visible single failure. Masayoshi Son publicly described the WeWork investment as foolish. Neumann launched a new real estate venture and, according to public reporting, pursued legal claims related to the valuation at which SoftBank bought out his shares. No regulator has issued findings of fraud against Adam Neumann or SoftBank in connection with WeWork's collapse. No criminal charges have been filed. What WeWork leaves behind is a case study in what happens when governance structures are designed to concentrate power rather than distribute accountability. When boards approve what they are told to approve. When the size of a check substitutes for the rigor of a question. Every investor who lost money in WeWork's public offering, every employee who lost their job without adequate notice, paid the price for a system that was built, deliberately, legally, and with full professional blessing, to make scrutiny difficult. The lesson is not that visionary founders are dangerous. It is that vision without accountability is a liability, not an asset, and that the institutions designed to provide that accountability have both the power and, some would argue, the obligation to use it. Here is the question I keep coming back to. When an entire chain of professionals, board members, bankers, lawyers, auditors, all reviewed the same governance structure and none of them stopped it, who do you hold responsible for what happened to the people who lost everything? Tell me in the comments.